All right, so imagine this. You're in a trading room, right? And all the screens are just flashing red. Headlines everywhere are screaming about this huge sudden drop in the US dollar. Like it just tanks on the global markets.
Oh, wow.
Not just a little dip, we're talking like a full-blown shock to the system.
Yeah.
Now, for companies doing business across borders, this is a nightmare scenario. Think about like a company that makes stuff, right? They get parts from Europe but sell everything here in the US. Or a tech firm with tons of revenue coming from overseas. Suddenly, all their budgets, their profit projections, everything is out the window. Gone in a matter of hours. Poof.
Yeah, I mean, that's a pretty vivid picture. Sounds intense, but honestly, it's not that far-fetched. It really hits home how important it is for businesses to really understand, like really get a grip on how much they depend on the US dollar.
Right.
Because as the big dog, the top global currency, any wild swings, especially the unexpected ones, they can really mess with the company's bottom line big time.
Yeah, absolutely. And that's exactly what we're digging into today. We're going to zero in on the US dollar, but specifically from the perspective of corporate risk management and how to handle all that volatility. So let's put ourselves in the shoes of, say, a CFO or a chief risk officer, right? They're facing this chaos. Where do they even start to figure out the damage? What tools do they use? What are the strategies to not only ride out the storm, but to actually keep the company stable, keep it going strong? How do you build that resilience, that toughness when the markets are so unpredictable?
Right. Well, to really get our heads around this, we're going to pull insights from a bunch of different places. So we're going to look at how some of the big institutions, like the European Central Bank, the ECB, the Bank for International Settlements, the BIS, how they analyze these big economic trends and overall financial stability. We'll also bring in some strategic perspectives from organizations like BCG and even tap into some really interesting academic research that dives into the whole psychology of financial markets and how people make decisions when the pressure's on.
Love it. So for you listening, today we're all about pulling back the curtain, giving you a peek behind the scenes at the strategies and frameworks that businesses actually use to deal with these crazy swings in the dollar's value. We're talking real-world corporate finance grappling with some pretty serious risks.
Yeah.
Okay, let's jump in. The US dollar is obviously way more than just the cash in your pocket.
Right.
What makes it so central, so powerful in the global financial system?
Well, I think to understand that, you kind of have to look back, look at its history. As Wikipedia lays out, the dollar's rise to the top, becoming the #1 international reserve currency, it all really took off after World War II, especially with the Bretton Woods Agreement. It basically pushed aside the pound sterling. That historical, that shift really set the stage for the dollar's dominance today.
And that dominance is still going strong. I mean, the dollar's still the king when it comes to international deals. Pricing oil, commodities, settling those massive trade agreements, or just being a safe haven for investors, the dollar is the go-to. And importantly, it's a free-floating currency. Can you break down what that means? Why does that matter when we're talking about all this volatility?
Sure. So a free-floating currency basically means it's not tied down to another currency. Its value isn't controlled, artificially by some government intervention. Instead, its exchange rate compared to other currencies, it's all about supply and demand in the foreign exchange market. That makes it super sensitive, maybe even more volatile to all sorts of things, economic news, political stuff, even just how investors are feeling. So when we're trying to manage these dollar swings, that free-floating thing, that's a big piece of the puzzle.
And that brings us to monetary policy, which, as Wikipedia also points out, plays a huge role. We hear all the time about the Fed, the Federal Reserve, raising or lowering interest rates. How does that actually impact the dollar's value directly?
Yeah. So when the Fed hikes those interest rates up, assets in dollars like U.S. Treasury bonds, they start looking really good to investors all over the world because they're offering a better return. That higher demand for dollar stuff means there's a bigger demand for the dollar itself in the foreign exchange market, which can push its value up. On the flip side, if the Fed lowers rates, it can make those dollar assets less tempting, and the dollar could weaken. So, bottom line, the Fed's decisions, they have a direct impact, often immediate, on exchange rates.
Okay, so let's circle back to that dollar shock scenario we talked about at the beginning. Whether the dollar suddenly shoots up or plummets down, what are the instant headaches companies have to deal with?
Okay, so let's say the dollar strengthens like crazy, right? U.S. exports, they suddenly become way more expensive for anyone buying in other currencies. Picture a European company, they want some American-made equipment, boom, now it costs them way more euros. This can cause demand for U.S. goods and services to drop, which could really squeeze the profits of American exporters.
Ouch.
Now, flip it around. A stronger dollar means imports are cheaper for U.S. companies, which could actually be good for those who get a lot of their supplies from overseas. Now, if the dollar takes a nosedive and weakens sharply, it's like a mirror image. U.S. exports, they get cheaper, more attractive, but those imports, they start getting pricey, potentially leading to higher costs for U.S. consumers and businesses that need those foreign goods. For multinational companies with operations in a bunch of different countries, with money coming in and going out in various currencies, these sudden shifts, they can create huge swings in their earnings and make financial planning a real nightmare.
Yeah, it's a wild ride for sure. And it's not like this is happening in a vacuum. The global economy is so interconnected. As those BIS papers on financial stability really highlight, a big move in the dollar's value can have ripple effects throughout the entire system. How does that actually play out?
Right, because the dollar is woven into the fabric of global finance. It's the main currency for trade, for investments, for debt. So a major shock to its value can trigger volatility in all sorts of markets. It can affect the value of dollar-denominated debt held by other countries and companies. It often influences the price of things like oil and gold, which are usually priced in dollars. And it can even destabilize other currencies, especially for countries with close economic ties to the U.S., like a chain reaction. You pull one thread and the effects can be felt everywhere.
So CFOs and risk officers, they're constantly looking at this crazy, complex, and potentially volatile situation. How do they approach it? Where do they even begin to get a handle on these risks?
Well, the BCG CEO outlook really stresses this idea that in today's world, which is full of uncertainty, you got to be proactive, you got to be resilient. For finance folks, that starts with keeping a close eye on a whole bunch of economic indicators and forecasts. They're trying to get ahead of potential downturns or any event that could trigger those big dollar swings. So they're watching things like inflation, employment figures, GDP growth, geopolitical tensions, and shifts in global trade policies. Publications like the ECB Economic Bulletin, they offer really detailed analyses of these factors for the Eurozone, and there are similar resources for the U.S. economy, of course.
So it sounds like a constant process of economic analysis, always trying to spot those storm clouds on the horizon. What specific things related to the dollar are they paying the most attention to?
Well, changes in monetary policy, like we talked about, that's always front and center. Any little hint from the Federal Reserve about future interest rate moves, that can have an instant impact on the dollar. Then there's geopolitical instability. That's another huge one. Things like wars, political crises, even big elections in major economies, they can create so much uncertainty and drive investors either toward the dollar or away from it, as a safe haven. And finally, shifts in global trade balances and relationships are crucial. For instance, if the U.S. trade deficit widens, meaning we're importing way more than we're exporting, that can put downward pressure on the dollar over time.
Right, so they're trying to predict the unpredictable. But even with the best analysis, surprises happen. That's where understanding their own company's weak points comes in, right?
Oh, absolutely. This is step one, super foundational. CFOs and risk officers, they need to know exactly how their company is exposed to those U.S. dollar fluctuations. No guesswork. This means digging deep into their import and export stuff. How much money are they making or spending in dollars versus other currencies? They also have to factor in any debt they have in foreign currencies, because the dollar's movements directly affect how much it'll cost to pay back that debt. And then they need to look at the value of any overseas investments they've got that aren't in dollars. It's all about spotting every single point where they might get hit.
It sounds like incredibly detailed financial accounting. It reminds me of how that BIS paper talked about the territorialization of money, this idea that national currencies are so tied up with a country's economic identity and stability. It really highlights why managing dollar exposure is such a big deal for U.S. companies. It's not just about exchange rates, it's about how healthy the business is within its own economic environment.
Exactly. The dollar isn't just some tool for transactions. It's a cornerstone of the entire U.S. economic scene, and it plays a huge role in the global financial system. Recognizing that connection, that deep link, it emphasizes why proactively managing dollar exposure is so important for keeping companies financially stable.
Okay, so they've done the deep dive, figured out their risks. What's the next move? how do they actually protect themselves from these potential dollar shocks?
Mhm.
This is where those hedging strategies come into play, right?
Exactly. The main goal of hedging is to reduce, or even better, completely neutralize the negative effects of those bad currency moves on a company's financial performance. Think of it like buying insurance to protect yourself from potentially damaging swings in those exchange rates.
So what are the tools they use? What are those key financial instruments for this hedging stuff?
Well, some of the most common ones are forward contracts, currency options, and currency swaps. A forward contract, it's basically a customized agreement between two parties to buy or sell a set amount of a currency at a price they decide on beforehand on a specific date in the future. This locks in that exchange rate, gets rid of all the uncertainty about future fluctuations. Currency options, on the other hand, they give a company the right, but not the obligation, to buy or sell a currency at a certain rate within a certain time frame. This gives them more flexibility, but it costs money. You pay a premium for that option. And finally, currency swaps. That's where you exchange principal and or interest payments in one currency for the same payments in another currency. Companies often use these to manage longer-term currency exposures.
So it sounds like each tool has its pros and cons. You don't just pick the best one, right?
No, not at all. It's all about trade-offs. Forwards are pretty easy to use, but they also mean you can't benefit if the currency moves in your favor, like more than you agreed on. Options give you that potential upside, but you have to pay up front. And swaps can be really effective for the long haul, but they can also be more complicated to set up and to get out of.
Got it.
The best hedging strategy, it all comes down to the company's specifics. Their risk tolerance, their predictions about how currencies will move, the cost of each hedging tool, and their overall financial goals. Like, say a company expects a lot of volatility but isn't sure which way things will go. They might lean towards options to protect against losses but still have a chance to benefit from favorable moves.
Under the BCG CEO outlook really emphasizes this idea of building business resilience. How does using these hedging strategies contribute to that bigger goal?
Well, hedging is a core part of building that resilience, especially in a world that's so uncertain. By actively managing and mitigating the financial risk from currency volatility, companies can protect their earnings, keep their cash flow more predictable, and ultimately be in a better position to navigate those economic headwinds and keep growing sustainably. It lets them focus on their core business without constantly worrying about those unpredictable swings in exchange rates.
So hedging is all about being proactive, managing potential risks.
Yeah.
But what happens when those risks actually hit, like in our big dollar shock scenario? How do companies figure out if they can actually withstand that kind of event?
That's where financial stress testing comes in. It's like running simulations of extreme but still possible bad scenarios, like a sudden massive drop or surge in the dollar. You're trying to see how strong a company is financially and find any weak spots if those conditions hit.
So basically, they're doing what-if drills for their finances.
Yeah, exactly. Companies might model the impact of like a 20%, 30%, even 40% swing in the US dollar's value and see how that would affect their balance sheet, their income statement, their cash flow statement. They'd analyze how these made-up scenarios would impact their revenue, their costs, their profits, debt levels, and their overall liquidity.
What are they hoping to find out with these stress tests?
The main goal is to see if the company's current cash reserves and risk management strategies, including their hedging, are strong enough to handle potential losses from that kind of currency shock. Stress tests can uncover weaknesses in their financial structure that they might not even see under normal market conditions. And they can highlight areas where they might need to take extra steps to make themselves more resilient. And actually, a lot of companies find that their indirect exposures, like those of their key suppliers, pose a bigger risk than they initially thought during these tests.
It seems like a really crucial exercise, especially given how connected the global economy is these days. And under the financial sector, banks, insurance companies, they're often required to do stress tests related to all sorts of risks, including interest rate risk, which, like you said, can be tied to currency values. I think the Federal Reserve papers have highlighted that. So it's a pretty well-established risk management practice.
Absolutely. For financial institutions, these tests are often required by regulators. But for companies outside of finance, they're a valuable internal tool for proactive risk management and strategic planning.
Okay, so stress tests are all about the financial side. But a huge dollar shock, it could have a much bigger impact on a business. beyond just the numbers. What about the day-to-day operations?
Right, that's where business continuity planning comes in. This goes beyond just the financial hedging stuff and involves coming up with complete operational strategies to make sure the company can keep running its most critical functions during and after a crisis, like a really bad, prolonged dollar shock.
So it's not just about protecting the bottom line. It's about making sure the business can actually keep doing what it does.
Exactly. A sharp and long-lasting dollar shock could really mess with global supply chains, especially for companies that rely on international suppliers or sell a lot of products overseas. It could also make international trade much harder and potentially affect their access to loans and financing.
So what are some concrete things that would be part of a really solid business continuity plan in this kind of situation?
Companies might look at spreading out their supply chains across different regions and currencies so they're not so reliant on any single place or currency. They could also find alternative sources of funding, just in case traditional channels dry up. And they'd probably come up with backup plans for managing international payments and transactions if there's extreme currency volatility or problems with payment systems. As the BCG CEO Outlook points out, companies that prioritize this kind of operational resilience, being able to adapt, they tend to outperform their competitors in the long run.
Makes total sense. Being prepared for all sorts of potential problems, that could be a huge advantage in a world where things are so unpredictable. Now, we've talked a lot about models, strategies, financial tools, but in the end, it's people who are making decisions and implementing these things. Does that human element really play a big role in all this?
Oh, without a doubt. The field of behavioral economics, like in books such as An Introduction to Behavioral Economics, reminds us that when we make decisions under uncertainty, we're not always perfectly rational. Ideas like prospect theory show how just the way a financial risk is presented can totally change how willing we are to take or avoid that risk. In a super stressful situation, like a sudden dollar shock, cognitive biases can sneak into financial decision-making. Things like panic selling or being overconfident about predicting the market, that can lead to some bad choices.
So even with the best, most sophisticated risk management in place, human psychology can still throw a wrench in the works.
Yep. Fear, uncertainty, even overconfidence can cloud our judgment. That's why clear communication, strong leadership, and well-defined decision-making protocols are so important when you're dealing with a financial crisis. Having set processes can really help minimize those behavioral biases and make sure responses are more level-headed.
It's a good reminder that even in finance, where things seem so objective, the human factor is always there. Okay, let's wrap this up. What are the big takeaways for our listeners from this deep dive into managing U.S. dollar risk in the corporate world?
Okay, well, first off, you got to understand the U.S. dollar's central role in the global financial system, how powerful it is, how its volatility affects pretty much every business that operates internationally. Second, companies have to be proactive. They need to figure out exactly how much they're exposed to currency fluctuations across their entire operation. No stone unturned.
Right.
Third, they need to use those hedging tools strategically. Things like forward contracts, currency options, and swaps. That's vital to soften the blow of those dollar movements. Fourth, running those tough financial stress tests, simulating those extreme scenarios, helps companies find their weak spots and make sure their financial cushions are big enough. And finally, they need to create and use those robust business continuity plans, the ones that address those potential operational disruptions, not just the financial stuff. That's crucial for building long-term resilience in these unpredictable markets.
So it's a multi-pronged approach. They need to be doing in-depth economic analysis, using financial tools strategically, and planning carefully for how their operations could be disrupted. Hopefully you listening now have a much clearer picture of the sophisticated strategies that companies use to handle the risks that come with the U.S. dollar and why these steps are so critical in our global economy where everything's connected. It's definitely a lot more complex than just glancing at the exchange rate each morning.
Oh yeah, for sure. And it's always changing as new economic realities pop up and financial instruments keep evolving.
That's a great point. And on that note, here's something to think about. Given how uncertain global financial markets are and how important the U.S. dollar continues to be, how might new technologies like blockchain or using AI for forecasting or big geopolitical shifts in the future, how might those things change those traditional corporate risk management models related to currency? It's a fascinating area to keep an eye on as you keep learning.